Welcome everyone to this explainer, where we're going to peel back the layers on Innoviva's fascinating turnaround and their really unique dual-engine business model. If you follow the biopharma space, you already know how incredibly cash-intensive it can be to bring a drug to market. But Innoviva is playing a totally different game, and their Q1 2026 numbers show us exactly how that strategy is playing out in real time.
So currently trading right around $22.44, Innoviva is a biopharmaceutical company with a corporate structure that, frankly, confuses a lot of retail investors. It's not a pure-play royalty company, but it's definitely not your traditional clinical-stage biotech either. By the end of this explainer, we are going to make their operational structure and financial momentum crystal clear for you.
Here is our roadmap. Number 1, meet Innoviva. 2, the dual-engine business model. 3, Q1 2026 financial highlights. 4, capital strategy and buybacks. And 5, analyst targets and risks.
Okay, let's jump right into Section 1. Meet Innoviva, bridging royalties and therapeutics.
The traditional biotech life cycle is often just a huge race against the clock, right? You raise capital, you burn through it in clinical trials, and you basically pray for FDA approval before the money runs out. Well, Innoviva actually flips this script completely. Instead of just burning cash on early-stage research, they use established, cash-flowing royalty assets to directly fund their next generation of critical care medicines. It's a structure built entirely for sustainability.
Moving to Section 2, the dual-engine business model, the fuel and the engine. To really grasp what makes Innoviva tech, you got to look at it as two synergistic halves. On one side, you have the core royalties. These are passive, steady royalties collected from massively successful GSK respiratory assets. On the other side, you've got the Innoviva Specialty Therapeutics platform, or IST. This is their fast-growing, in-house portfolio focused on critical care and infectious diseases in hospital settings. So think of those core royalties as the fuel which directly powers the engine, the IST platform.
You can see the two halves working perfectly in tandem right here. The steady royalty earners, the fuel, like the widely prescribed Anoro Ellipta inhaler on the left, pay the bills. And that cash flow allows the engine on the right, fast-growing critical care therapeutics like Japreza, to aggressively scale up and capture market share.
All right, Section 3, Q1 2026 financial highlights, a massive turnaround.
Taking a look at the top line, Innoviva delivered a really solid 11% total revenue growth year over year. They jumped from $88.6 million in Q1 of 2025 up to $98 million in Q1 of 2026. This proves the combined model isn't just stable, it's actively expanding. But the real story is actually hidden in how that revenue breaks down.
This is where the narrative totally comes together. Notice how their royalty fuel actually dips slightly, down 4.4% to $58.6 million. But the therapeutics engine, it absolutely soared. Total net product sales grew a massive 37% year over year to $41.4 million, driven heavily by $34.2 million in the US market alone. So the engine is generating serious independent momentum now.
And the absolute crucial point is this staggering figure, $186.6 million in net income for the quarter. To put that into perspective, that translates to $2.52 in basic earnings per share. This marks a sharp, highly profitable turnaround from the prior year's losses, proving the model is driving massive bottom-line value.
CEO Pavel Reifeld directly highlighted this commercial progress, pointing out that 37% growth figure. This shows us that their in-house therapeutics, the IST platform, are successfully capturing market share. They're proving they can successfully commercialize these critical care drugs, taking them all the way from concept to actual growing cash flow.
Section 4, capital strategy and buybacks, deploying the cash.
They certainly aren't just sitting on their hands either. Innoviva has been aggressively deploying capital into a $125 million share repurchase program, buying back over $20 million in stock, which is nearly 1 million shares in Q1 alone. Furthermore, they're actively managing a massive portfolio of strategic healthcare investments, which is now valued at a staggering $773.3 million.
Actually, quick aside here. That massive $186 million net income figure we looked at earlier wasn't entirely from product sales. A huge chunk of it came from a $191.2 million positive fair value adjustment in their equity investments, and the star player there was Armor Pharmaceuticals. Innoviva's strategic investment in Armasata saw significant share price appreciation this quarter, underscoring Innoviva's secondary skill, acting as a really savvy healthcare investor.
From a corporate government standpoint, it's also definitely worth noting this recent move.
Innoviva filed a nearly $208 million shelf registration to issue shares tied to an employee stock ownership plan, or ESOP. The whole goal here is to directly align their team's long-term incentives with shareholder value as they continue to build out that therapeutics platform.
And finally, Section 5. Analyst targets and risks. The bull versus bear case.
Based on a consensus of 7 analysts, the current average price target for Innoviva sits at $37.67. Remember, as we saw at the very beginning, the stock is currently trading in the low 20s. So, the consensus view on Wall Street suggests a rather significant premium to today's price tag.
But that consensus actually hides a pretty wide spread of opinions. The 3 most recent ratings from firms like H.C. Wainwright and BTIG average over $43, which implies a massive 93% upside. Scotiabank goes even higher with a $55 target. However, we absolutely must be objective here and note the bear case. Goldman Sachs holds a much more pessimistic view, with a $17 price target implying some real downside risk.
And to keep things completely balanced, we have to look directly at the risk factors outlined in their filings that inform that bear case. Innoviva's legacy royalty revenue, the fuel, could drop faster than expected. Also, the IST portfolio is competing in crowded hospital markets. Commercializing new drugs and getting doctors to adopt them is notoriously difficult and expensive. There's always the risk of regulatory hurdles, and of course, the risk that their investments in other healthcare assets could underperform.
Which leaves us with this final thought for you to explore. We've seen the mechanics, the steady, albeit slowly declining fuel of legacy royalties acting as a fundamental margin of safety, combined with a rapidly expanding, highly profitable therapeutics engine. They're buying back shares, sitting on a mountain of cash, and Wall Street is completely divided. Does this unique dual-engine model make Innoviva an opportunity you simply can't ignore, or do the very real risks of drug commercialization keep you on the sidelines? Thanks for joining me on this explainer, and keep learning.